Jadi bagaimanakah sesebuah organisasi itu dapat memenuhi manfaat dan juga memberikan pulangan kepada semua pihak yang berkepentingan di dalam organisasi berkenaan dan juga di luarnya, dan juga bagaimanakah strategi jangka masa panjang ini dapat diguna pakai oleh institusi yang lebih besar seperti sebuah negara ataupun sebuah rantau contohnya. Saya Riza Zulkapi, ini AWANI Global. So, Dominic, you have heavily criticized short-termism and also quarterly capitalism. Why is this? Why should we look away from this and look at long-term growth and investment?
Yeah, I'm concerned with quarterly capitalism or short-termism, because what it inevitably does is you get a short-term pop-up in value at the cost of long-term sustainability of the organization. Short-termism means that you don't invest as much in R&D as you should be. Short-termism means you don't invest in talent as much as you should. It means you don't invest in the broader stakeholders. So it forces organizations to be more narrow-minded and I think therefore less viable. And especially in a time of a lot of change where you have to reinvest and there's a lot of opportunities to build new things, you need to have that kind of a perspective. And that's why long-term investors are actually a very important driver of that for companies.
But you've also mentioned that the pressure to perform on a quarterly basis is coming from the investors, which then force it on the board and also on the management. Can you talk? Yeah. Can you share with us this chain of force?
Yeah, and what we looked at was to say why has capitalism become more short-term? I think really since the 70s, early 70s. And I think it's partly because of what I just call it the financialization of the economy. We just have a huge financial sector, which is nothing wrong with that. That's good for creating all sorts of other opportunities. But there's then a lot of capital flowing around, moving in and out, hedge funds and so forth, automated trading. And what that does is you'll get a long-term investor, like a pension fund that's investing for 60 years, let's say. They give some of their money to an asset manager. The asset managers then invest in the companies and they care about what the boards are doing. That's kind of the value chain. And the reason why we go from a kind of long-term mindset to short-term is many of those long-term institutional funds, when they give a mandate to an asset manager, are actually looking at the short-term performance. If that fund isn't delivering results on an annual basis, they kick them out. So all of a sudden that long-term money is being focused on short-term. And that pressure is translated to boards who then say, people say, I want dividends and I want share buybacks, right? It's sort of, and that puts pressure on the CEOs who are saying, well, I've got to deliver the results or my investors will be upset, my asset managers. So that's kind of the chain of what's happened, and it's got worse over the last 40 years. It's got progressively worse. Shares are held for a much shorter period of time than they ever were. And in publicly listed companies, a lot of them, they're widely held, right? You got a lot of, and they're passive often. And so you don't hear much from those players. What you do hear from are the activists. Who are very loud and typically own less than 5%, 4 to 5%. They make a lot of noise, and that again leads to short-term gains at the cost of long-term sustainability.
How can these big-size investors play an active role and take out maybe work together with the asset managers to also be making a lot of noises to these firms?
Well, I think as we discussed in the session, Mark Wiseman from BlackRock was talking about it. I think what has to happen is first of all, long-term investors have to be more active, the point you made. That means and you're seeing this with BlackRock, Vanguard, State Street, some of the biggest investors in the world are actually increasing their corporate governance troops, if I could call it that. People that will actually spend time with the boards and say, look, you should be investing more, why aren't you doing? So they're beefing up their capabilities to influence the boards and the management team, so that they've actually got a voice. That's a very important part of it. The second thing I think that long-term investors can do is have mandates to their asset managers which are not just 1 year. and have 1 year, 3 year, 5 year, 15 year. That's what GIC does in Singapore. So they're saying to their asset managers, we're not just going to look at you on an annual. That's a small portion of our evaluation. Our biggest part of evaluation is what you do over time. So that allows the asset managers to be more comfortable with the company not in delivering the dividends or the share buybacks, but investing more, because they know that their real incentive is over the long term. But not very many institutional investors do that. So it's the incentives and mandates they provide, and then their active ownership where they have to take it up. The challenge is if you're someone like BlackRock that has over $6 trillion, they by definition almost own a chunk of every company. It's hard. You'd have to have a huge staff to do it. And I think they're being very thoughtful as to how they do it, but they've got to think about where they engage in that to be able to have influence and voice.
We know that the asset managers, they have a lot of resources and the best human capital to manage this, but do the owners know what they're getting into? Or do the owners know, have the ability to also make noise in that sense, as much as the asset managers?
I think they can, because and this is again, if I go to Larry Fink and the letters he writes, they get a lot of publicity. He goes, I want to know what your purpose is, and I want to know what your long-term strategy is. And by the way, I expect it to change. I don't expect it to stay stable, but I want to see that. And by putting that voice out there, that's very, someone of that scale, that hasn't, people put their, snap their heads back. And so I think by publicly talking about it, by making examples of companies, by they spend a lot of time with CEOs, right? A lot of CEOs are passing through the offices there, and in Vanguard and other places, because it's important. So I think there are ways of actually getting your voice to the asset managers. But I think again, I really admire what GIC's done with this set of incentives, their mandate, which is spread over time. And some of the Australian pension funds are doing that, and some of the Canadian ones are as well.
What are the values that will be created when we look at something beyond 1 or 2 years to the economy and also to the firm?
It's, I think, pretty significant. I mean, we did, just as an example, some work in the United States. We looked at the period 2004, I think it was to 2016, and we looked at short-term companies and long-term companies in the similar peer groups. So, consumer goods are different than financial services. We looked at peer groups, and we had a way of identifying short-term, long-term. And what you found is that the long-term companies invested significantly more in R&D. They created more jobs. They actually had far better performance over time. The interesting thing is, over that period, that the crisis occurred, and you'll see that the long-term players got hammered harder in the crisis because they didn't cut R&D. They didn't cut, the investments they're making in talent. They didn't cut their sort of innovation rate. Their R&D actually stayed constant. The short-term players cut everything they could. So there were periods where the short-term players outperformed, but over time you would have wanted to have invested stock in the longer term. And that has big consequences on, again, GDP growth, fundamentally, employment. These are all related, and then fundamentally performance. So it has real consequences. And that's why I think there's a real need to make sure we shift from this quarterly capitalism to more long-term. It's just for the health of the economy.
But how do you suggest firms engage with the investors, board, management, to ensure that, yes, we probably report the quarterly numbers, but let's look at the future values of the company as well? Because I think in some jurisdiction, you still have to report the quarterly numbers, right? But how do you make that a long-term outlook?
A great question. I mean, what I think is not just having, you do need to report short term. I think it's okay to report quarterly numbers. The thing is not to give quarterly guidance, like where you say, I'm predicting that our profit will be X on 3 months from now. I mean, most companies aren't run that way, if you know what I mean. Imagine if you're a long cycle company, like a mining company, or you're in aluminum manufacturing. These are long cycles, so the idea that you're going to so that's the stuff you don't want to do. I think the way, sort of to get to your question, you sort of get the long term in there is, I think, to be able to say, look, these are the short-term results that we have right now, but we have another set of measures we want to tell you about, which are more health measures, which relate to our strategy. And I would be reporting on those, even though no one's asking for them. You know, IBM does this. Westpac in Australia does this. They talk about measures they think are important for their strategy, which may be around diversification of the business streams in terms of where they're going. It may be a geographic presence. You know, we are going to move from 1% of our business being, I'm making this up, to being in China to 15, and we expect, here's how we're doing on that front. Our turnover of top talent, or our employee engagement, which is a health measure. SAP, for example, measures that quite rigorously and actually tries to quantify the value of that. I think it's for every 1 point of employee engagement. We should double check this. I'm going by memory. I think they're saying it adds $49 million to the bottom line. So they've actually analysts aren't asking for it, but they present it. So I think what is good is, yes, show your quarterly numbers on the financials and so forth and returns, but also show your quarterly numbers, or maybe it's every 6 months, on your health measures. And that can, investors, I think, long-term investors will like that.
So there should be a focus on the vision of the company as well, moving forward 5-10 years, where they want to be.
Where they want to be, and what sort of progress are you making in getting there. And I think that's where I think companies can do a better job, like pharma companies or companies that actually do a lot of R&D, because it can look like a black box. And so it's not sort of saying, it's hard to measure that, but it could even be saying, well, these are the drugs we have in process, in various stages of a process, and talking in quite some detail so people can see it. But everyone will have their own health measures that are different.
But what are some of these new metrics that should be there to be measured and to be looked at by investors looking to invest in a forward-looking, long-term organization?
Well, I think there are categories, and I think then for each one you could get quite specific. But I think there's the following categories. One is innovation, something about the innovation rate. It could be R&D expenditure. It could be the percentage of business that you're doing that didn't exist 5 years ago. That some companies do that. 3M was always a classic. They always wanted to have 30% of their business, I think it was, being not new from a 5-year ago period. It was just kind of a marker to show how they're. But you need an innovation measure. You need something on talent, and there's a range. But it could be the engagement. It could be the leadership bench that you have. But something around talent is you've got to have some measure on that front. I think there's a third one, which is around your stakeholder management. What's the trust levels? There's a trust bank. Every company has a trust bank. And how are you doing? You always have low lights and highlights, but you should be building that, and that's going to help you deal with a crisis and prevent serious damage being done if you're working that. Everyone has a crisis from time to time. So those are three areas, I think. And then for each company, I think you should get quite specific about what it means to you. What does innovation mean for Dow versus Microsoft versus an automobile company? And those are going to be quite specific. But those are some of the categories I'd be thinking about.
If you look at the volatility in the global economy right now, especially with trade, is there room for long-term planning? Because if you can only plan so far ahead, and if the more short-term it is, the more safer to an extent it can be. Is there room for long-term planning in a volatile environment?
It's a great question. I actually think there is. I think you actually need to have both. you need as one CEO told me, if he could teach his younger self what to do differently, he said, I would have learned how to put a microscope in one eye and a telescope in the other without getting a headache. Obviously he didn't do it, but conceptually it's, you have to think short term, but at the same time you can't keep your eye off the long term. And I think even in this time where it is definitely way more volatile than it has been, you must have beliefs in the world and where you're going. My personal belief, for example, is I don't think we're going to move into a zero-sum trade situation for the long term. I think it will be for the next 5 to 7 years. It's going to be tough. But having that view could give you opportunity, because a lot of people will be running away from things and you may actually want to invest. So a lot of people will be nervous about their relationship with China if you're doing a lot in the U.S. My view is I would be looking very hard at what are some of the things you could do that may only pay off in 5 to 7 or 10 years. I literally would be making some, because then you're going to get a significant return. At the same time, you have to be nimble to say, if my trade is changing, my supply chain, I have to fix that now, or I could be out of the water. But you can do both. It's not one or the other. I think you need to do both.
Let's look at the role of the board in today's world. How can board be also adding value to the firm? Because there's always this corporate nightmare of board not agreeing with management. There's always that relationship that's very hard to manage. But how can they work together to add value to the organization and move towards a long-term win-win partnership and not just board picking faults of the management? How do
it's a great, even how you described, I think that there's always going to be tension, and there should be, I think. But I think that it's very important that there be alignment on what matters, what's the direction we're going, and therefore what are the key measures that we're going to be looking for long-term and short-term. I think, and by the way, those may change every 5 years, given how fast the world's moving. So I think it's very important that on a regular basis, there's a step back by both management and the board to say, what are we actually trying to achieve over the next 5 years? I'm involved right now in a mining company, and there's some really exciting and challenging things that will be coming up over the next 5 years. So we start by saying, forgetting, obviously fiduciary issues are always there and they matter, but that can't drive everything. They're kind of there as a baseline. It's like health, you have to do that. And then there's succession and the regular stuff in running a company that boards need. But even more important to me is, okay, what is this company trying to get done over the next 5 years? They may be, in this mining case, they may be building a massively new mine, which they don't do every year. So how are we going to make sure that that's built on time and on budget and all of that type of thing? How do we think about changes in the demand for the minerals that we're making that may be shifting quickly? Electric vehicles are coming in. That has a big use for copper. How do we think about what that means? So I think it's very important that management and the board agree on these are the kind of less than 5 things that are going to really matter over the next 5. And let's make sure we as a board spend the time on those things, right? So I think that's, because often there can be tension when you have different objectives. So you don't need to have different objectives. I think that's first, getting that right. And then second is the process by which the two groups work with each other. As I said, as you described it, even in the way you showed it, there's going to be tension, but there are ways of being able to deal with that, to make the management team feel, first of all, confident to give bad news or not. I was just meeting with a capital owner who said he loved working with one CEO, investing in one CEO, because the CEO would always start with lowlights and highlights. It takes a lot of guts as a CEO to start with, let me tell you how I've messed up or how things didn't go well or whatever. They start with that. And then they also, so it's very open. People can say what they think, but there's sort of an understanding, in my view, that management's running the show. Boards can't. And then then it's an open environment, lots of feedback to say, this board meeting wasn't very helpful, or this isn't adding much value, or the board saying, we're not we don't feel like we're not adding any value because we can't get the information we need to. So lots of time to be able to get the dynamics right, because they can be a bit like families, boards. That the dynamics continue generation after, and there's the tension that is there naturally, and it can get worse and worse and worse if you don't have these break periods to say, okay, let's step back, see where we are. Not the formalistic stuff, but the informal.
What are some of the characteristics of the board members of the future and of the digital age, where you can access to information really fast and you get this overload of information coming from right, left and center for you to help decide where the company or the firm is moving forward?
Well, I think to exactly your point, I think one is the ability to synthesize a lot of information and say, what's the so what for this company? Because you could just get you can swim in the data and the information, and so you got to be able to figure out a way to digest and make that relevant, and I think that's more and more demanding because of all the information that's out there. I mean, if I look at typical board books and the boards that I've been involved in, the pre-read before a board meeting is typically 1,000 pages, right? It's just it's a pile, and so how you can synthesize that, how the management team can actually better prioritize the information, so you're framing the issues properly is key. But I think more fundamentally, board members need to, you have to have a minimum level of understanding of the industry. You cannot just be a intelligent person that's kind of you better understand the value drivers that are there, and so you don't have to have been in the business, but you better invest the time to understand it. And then I think you should know something about something. Like it may be about talent. It may be about you know a lot about an important region of the world for this particular company and where it's going. It may be that you know a lot about innovation, right? You may know a lot about brands, but there's different. You should have a spike, what I call it, and you have a basic judgment and understanding of the industry, which is the T, and then you have the spike, which is I'm deep in an area, which can really help the company.
And lastly, let's look at diversity as not just a buzzword, but something that people should implement or firms should implement. And how can, let's go back to the investors, how can investors and big asset holders ensure that diversity happen at the board level and it's carried out properly?
I think it's again one of the mandates that they can lay out. I mean, just recently you see in California, that it's more a regulation than it is a investor doing it, but there's no reason why investors can't, but they're saying we expect on every board there be one woman. It's just you have to do it. And I think there's something to that. And Mark Wiseman was talking about it in our panel discussion. He said diversity is an economic issue. It's not a moral issue. You get better decision making when you have diversity, and it's not just about men and women, it's ethnicity, it's different lifestyle, it's different perspectives, a different way of thinking. You get a far better outcome. And I think investors should be more demanding about that and say, I expect that. And I think that people will listen to investors. They have a lot of power. And saying, again, it's not because of a moral issue or because it's corporate social. We think the company will perform better having a more diverse board. So you got to do it. Tell us how you're doing it on that.
Thank you very much on that note.
Thank you.
Thank you.
Thank you.
Setiap sekuan, syarikat akan mengumumkan keputusan kewangan mereka. Namun bagaimanakah kita melangkaui amalan tersebut dan melihat kepada strategi jangka masa panjang? Saya menemu Bual Dominic Button daripada McKinsey & Company ketika Khazanah Mega Trends Forum di Kuala Lumpur untuk melihat kepada strategi jangka panjang sesebuah institusi dan bagaimanakah ia akan memberikan manfaat kepada institusi tersebut. Rizal Zulkafli untuk AWANI Global.